Hello and welcome to the Thailand, Netherlands double taxation essentials for Dutch expats. If you do have any questions, feel free to put them in the Q&A box and we'll hopefully get through those throughout the webinar. My name is Carl Turner and I'm the co-founder of Expat Tax Thailand. As you can tell, I'm a British person talking about Dutch and Thai taxes. So gratefully, I'm joined by a real Dutchman today, Joost. So I'll leave just to introduce himself, who is our guest, co-host guest. So welcome, Joost.
Yes, thank you, Carl, for this glowing introduction. We discussed that I will introduce myself in Dutch, as most of the audience is probably able to understand Dutch. And then we'll switch back to English for the presentation. Ja, zoals Carl zei, ik ben internationaal belastingadviseur. Inmiddels 10 jaar actief in de internationale praktijk. Gebaseerd in Amsterdam. We hebben ook kantoren in Breda en Arnhem. En we helpen eigenlijk business owners, ondernemers, DGA's die internationale fiscale vraagstukken hebben. En dat is in mijn praktijk vaak Midden-Oosten en Zuidoost-Azië. En dat heeft dus te maken met exitheffingen, met verdragstoepassing, met winstverdeling, transfer pricing. En al die onderwerpen komen vandaag ter sprake. Back to you, Carl.
Okay, great. Thanks for that. So, Expat Tax Thailand, we are a Thai tax filing licensed accountancy company and tax advisors. We help thousands of expats with their Thai taxes countrywide. We're proud to have over 550 five-star reviews on Google for how we provide advice and service for clients. So we're authorized and regulated by the Federation of Accounting Professions, and all of the accountants and tax consultants are English-speaking Thai nationals with decades of experience. So there's a lot of information on here. And if you've got any questions, feel free to arrange a free consultation with one of our English-speaking consultants. They'll be happy to have a video call or phone call to answer any of your simple questions. So let's go through the agenda. What we'll go through today is we'll go through the current tax rules. We'll explain who needs to file and what are the key dates in the Thai personal income tax calendar. We'll explain briefly about double taxation agreements and also the implications of not filing taxes. We'll talk about the common allowances and deductions, talk about some Dutch tips and key information, and also some of the current worries for Dutch taxes as well. So the Thai-Dutch double taxation agreement, 1975 when it's signed, 31 articles, and whatever is included in the double taxation agreement supersedes the domestic tax rules. So whatever states on here overrules whatever's in the domestic tax rules. And it prevents taxes really being paid twice on the same income. Doesn't mean that you won't pay in both jurisdictions. It just means you likely pay the higher of both in a lot of cases. So we'll go through that in detail as well. Just will help us with this. So to start with, it might be good to go through some of the current worries from anyone who's got any assets in the Netherlands or a tax resident of the Netherlands. It might be good for just to explain this.
Yes, and I'll do it in English this time, so you can also learn, right? And well, I think everybody in the audience has heard something about Dutch exit taxes. It has been a big thing on social media and also in the mainstream media. There has been talk in Dutch Parliament about a general Dutch exit tax, meaning that for 5 years you will basically be treated as a Dutch domestic tax resident, even if you're not. This is a quite scary proposal, but it's only that. It is only a question of a member of parliament to the government to look into this. They've basically said, sure, we will look into it in a European context, which means it's postponed. And as you all know, the government has fallen and has fallen again. Elections in 2 months, so who knows? For now, there's no concrete proposal for a general Dutch exit tax. However, we already have exit tax. Has been the case for a long time. We have exit tax for companies on a corporate tax level, and we have the so-called conserverende aanslag. This is a quite nasty one. It means that the Netherlands will tax you on the rise of value of your own company, even if you have not paid the dividends out or you have not sold it. So unrealized gains on the value of your company, when you move away from the Netherlands, you are taxed on it. If you move away outside the European Union, so to Thailand, you do not get an extension on the payment. This means that some company owners who have a great company but not a lot of cash cannot move to outside the European Union. It's crazy, but it is the way it works. There's workarounds, we advise about that, but this is the default setting. If you leave with a company, you pay on the unrealized gains. Later on in this webinar, we will see that in the case of Thailand, this can lead to a very nasty double taxation problem. We'll be sure to touch on that later. So that's one thing, that's the exit tax. The other thing that people talk about a lot these days is the new box 3 system. As you all know, the Netherlands has a system of fictional taxation for savings and investments. We've all been complaining about that for years. Now there is a new system and we're complaining about that even more, because it turns out that everyone who is good at investing, is going to pay more tax in the future under the new system. I wrote 2 quite long blogs about this that you can see on our website. I find it a very fascinating subject, so feel free to reach out to me to discuss. But the bottom line is that we'll be going to tax real return on investment, which is, I guess, a good but expensive thing for most of us. For Dutch Thai purposes, the most important one is Dutch real estate. If you live in Thailand, you have Dutch real estate. Until now, you were taxed on a fictional return on investment, which is usually quite beneficial. From 2028, you will be taxed on the actual rental income minus things like maintenance costs. And when you sell the property, you will be taxed on the capital gains. More details about this in my blog. And there's a third worry that I want to point out here, and that is het woonplaatsonderzoek. Maybe it happened to one of you already. If you live in Thailand, but you are Dutch and you lived in the Netherlands before, the Dutch government doesn't always accept that you are a tax resident of Thailand. And we have seen very unfortunate examples of this in the past. People who have a house, a car, a wife, a child, 10 bank accounts and a company in Thailand, and the Dutch government still claims them as tax residents and then goes on claiming their companies as tax residents. This is something you really want to avoid. So I always say, if you're going to move and if you don't want to pay tax in the Netherlands anymore, really move. Just start a new life in Thailand. Try to burn as many bridges behind you with the Netherlands. If you do get into this,
is that things just like having a spare, like an apartment that you can use in the, if you do go back, like an empty apartment, is that the definition of sort of having ties to the Netherlands, that they could claim that you are not a non-resident, or what kind of ties are they that they do look at with this?
Yeah, this is one of their main arguments. If you have a place available in the Netherlands, that will certainly be seen as a tie to the Netherlands. If you have a place which is rented out, that's fine. So you can own real estate in the Netherlands, completely fine, but it shouldn't be at your disposal. Another thing is, of course, family. Like if you have children, even if you're divorced, if you have children in the Netherlands and you go visit them 5-6 times a year, that can certainly be construed as being a tax resident of also the Netherlands.
Right. Yeah. Yeah, quite a bit to worry about then. Yes. Okay, so let's get into the Thai tax rules. So just to clarify, the current tax rules have not been changed or amended from last tax year. So the same rules apply as 2024. There are no changes to the foreign income remittance or domestic income tax rules or crypto tax rules. There have been mentions in the Bangkok Post and discussions from the government about making changes, but they have not been signed off in terms of published in the Royal Gazette or anything put into the Thai Revenue Code or like a royal decree. So what does that mean with the current constitutional court terminating the Prime Minister's reign and then the current dissolving of the government? It's unlikely that there'll be anything that will be signed off for the current tax year. So what we propose is anyone who is looking for the remainder of the year to follow the current tax rules and not rely on rumors or potential changes that may or may not happen. So, it's likely that the rules could change, but for the current tax year that ends in 3 months' time, it's unlikely that they will be put into force before the end of the year. If you would like to be kept up to date, if you're watching this live, then you'll be added to our tax alerts. But if you're watching this online, you can subscribe to our YouTube channel or sign up to our tax alerts on the website where we'll keep you up to date with any future changes. So what are the current tax rules and what has actually changed in Thailand? So in late 2023, there was a departmental order which was issued by the government, by the Revenue Department, which changed the rules for personal income tax in Thailand quite dramatically for expats. What the current rules are is if you are a Thai tax resident, so 180 days or more, and you remit foreign source income into Thailand, then you are liable for tax in the year that it is remitted. This was published in the Royal Gazette in the late 2023, and the Thai Revenue Department have produced quite a lot of documents about how foreigners living in Thailand can pay tax. So they've produced quite a bit of documentation as well for this. So who needs to file a tax return in Thailand? One, if you have domestic income. So what does that mean? It means if you have a Thai rental property, you rent out a property and you receive an income, or you have a Thai salary, you have to file a Thai tax return. That's a given. Or if you so you stay in Thailand 180 days or more in a calendar year, that's not consecutive, that's throughout the year. So you could be here for 2 months, leave, and then come back. If you're 180 days or more, then you are a Thai tax resident. Then if you remit, which means transfer, spend, foreign source income, overseas income, then you need to file that on a Thai tax return. What are the common foreign source income sources? So things like overseas pensions, if you receive dividends from overseas, or investment capital gains, if you bring those to Thailand, transfer into Thailand, or you've got a rental property overseas, or you sell a property and you transfer that money into Thailand, then that has to be filed on a Thai tax return.
And by the way, Carl,
yes,
does not necessarily mean that if you meet this 180 days rule, that the Netherlands therefore accepts that you're not a Dutch tax resident.
Yeah, correct, Jay. So you can be in effect a Thai tax resident and a Dutch tax resident in the same tax year. So you could, in effect, you could have to file a Thai tax return because you remitted in foreign source income, but you could also pay the tax in the Netherlands and use the tax paid as a tax credit in Thailand. So in effect, you'd file both and you'll pay the higher of the both. That's the reality. So it can be quite complicated. Just because you're here 180 days, exactly what just mentioned, doesn't mean that you are a non-Dutch tax resident or any other jurisdiction. It just means you are a Thai tax resident for that year, for that calendar year. So who does it affect? It doesn't matter on your visa status in Thailand. So you could stay on a tourist visa if you can stay for 180 days. You're still a tax resident if you stay here for the amount of days. If you've got a retirement visa or a marriage visa or a permanent residency, it's all to do with days in Thailand. And so you can be a tax resident on any of the visa types.
Fundamentally different from the Dutch definition. In the Netherlands, you can be a Dutch tax resident for January through April, and then going forward, be a Thai tax resident. But in Thailand, you're always either a resident or not for the full year, right?
Correct. And the part what's quite confusing for people that move into Thailand as well is you could move in April and stay for 180 days. And your tax residency doesn't start from April, it's backdated to January. So anything that happened for the whole year, even though you weren't here for that first starting part, is part of a Thai tax year. So yeah, if you are moving to Thailand, it might be worthwhile having a discussion to see how to plan. It's quite important that you get it right, especially if you are selling assets overseas to remit in the future. It's important with timing. Key dates, so it's a calendar year, 1st of January, 31st of December. You need to file a Thai tax return by the 31st of March the next tax year. And also, if you've got rental income, there's a mid-year tax filing, which is the 30th of September. We've actually put in association with Learning Institute for Everyone, which is a Ministry of Education university. We've actually produced the Thai 2025 tax guide. So you can download that from our website. It has all the information about how to file and the rules for the current year. Also, we provide online tax filing services for clients. We've got an online client portal, make it very easy to file taxes for clients online. And what's the implication of not declaring taxes in Thailand? Well, Thailand signed agreements with most of the banks in Thailand, the revenue department have, to start to look for patterns and collect their data direct and input into their AI software to look for irregular or regular patterns in people's spending or remittances into Thailand. Also, with the Bank of Thailand, any inbound remittance, so anything you transfer into a Thai bank account, that data is automatically sent to the revenue department. And they are actively using AI now to look through, to compare to tax returns, to tax residencies and spending patterns. So yeah, that's one of the implications of not declaring is they're starting to go quite heavy on this AI route and then flag to an individual to look at the case. So how do they know? Common reporting standards, obviously in Netherlands, one of the founding members for automatic exchange of information and CRS. Thailand signed up in 2020 and started receiving data in 2023. So all of the information shared between the revenue departments. And for the amount of days that you stay in Thailand, it's all through the e-online system, our digital arrival cards. It's quite clear they've got the data already. Like all tax jurisdictions, pretty harsh in terms of penalties if people don't comply, up to 200% of the tax that's owed, plus surcharge 1.5% for each month that the tax has been owed. And then obviously criminal charges as well, potentially. But if people comply, it's pretty straightforward, to be honest. So what can the revenue do if they feel that you suspect of non-compliance? They can send a letter like this one to your address. They can actually call. They call a lot of people directly and can email as well. We've had clients have phone calls after they've submitted to say, why have you tried to claim that your spouse has got no income when they do, and things like this. So they're quite on the ball with it, to be honest. So they can send a letter just to ask you to provide information. They can ask you to the office, or they can ask you to upload everything to the online system. So there's different methods. So it might be good to start to talk through Dutch assets and if they are remitted to Thailand. So what we mentioned earlier just is this DTA is looking like it could be updated, correct? But it's not been signed off. Is that right?
Exactly. There is a new one ready to be implemented, but apparently well, the official status is that the Dutch government is waiting to get an appointment with the Thai government for a signing. So some things will change. This is a very old-fashioned and old tax treaty. So we will, I guess, comment on what is the situation now and speculate on what the situation may become.
Yeah. Okay. So the very clear and easy one is civil service pension. So if you've worked for the Dutch government, for example, then in the double taxation agreement, like all other DTAs with Thailand, 61 with Thailand, they actually show it's only taxable. It's tax exempt in Thailand and only taxable in the Netherlands. We assume that will stay the same.
This will stay. This will stay. Yeah.
Other pensions. So yeah, any other pension that's remitted to Thailand from the Netherlands is taxable in Thailand if remitted as a Thai tax resident. So let's assume you stay 180 days or more in Thailand in a calendar year and you transfer your Dutch pension into Thailand. It needs to be filed on a Thai tax return.
This seems to be maybe a little bit of a gap in the tax collection. Since if you don't remit it to Thailand, Thailand will not tax it either, right?
Correct.
So
Yeah.
presumably there will be some changes in the treaty about this.
Yeah. Next one is rental income from Netherlands. So rental income, like most countries, it's taxed in the country that the property is situated. So you can be a non-Dutch resident and be taxed on the local income. But it's exempt from the Thai tax base. But it's still added to add to your income for the other. So it's added to your remaining income. For the calculation, it just means that's not specifically taxed.
Yeah, and this works the same way the other way around. So if you are a Dutch resident with Thai rental income or other real estate income, you also have to record it in your tax return. It will be exempt. But if you don't put it in your tax return and they find out later, they will not only ask why you hid it, but also how did you get it in the first place? Which money did you use to purchase this property? And then there's fines, there's interest. So always just disclose, especially since it's exempt anyway.
Yeah. Okay, great. And then shares and stocks. Obviously, if you're a non-Dutch tax resident, then there's no tax on the capital gains. If you do sell assets, so shares, stocks, and you transfer those into Thailand, you are taxed on the capital gains. So not on the whole amount, it's only on the gain percentage. But the problem with Thailand is because it is a remittance tax basis, it's not year by year, it's all time gains. So it's not since you've been a Thai tax resident. It's not since you've been a Thai tax resident, it's since you have held the asset. So it means you could move to Thailand in 2024 to be a tax resident, and you could have held the stock for 20 years, and you get no tax break for holding it previously. You're taxed on the gains when you sell the asset and remit to Thailand. So that's one that might be good to sort of look at planning as well.
You have to plan this because in this example you gave, in 2024, in the immigration year, the Dutch will already have taxed you on the gain so far, even if unrealized. So this will certainly lead to double taxation. And I think, Carl, you have some tips and tricks to avoid getting into this situation.
Yeah, and maybe this is one of the things in the DTA that may change, right? Because, potentially.
The problem here, and we have this with many tax treaties, is that the Netherlands says that it is not a double tax situation because we tax you on the day you leave, and then it's just a Dutch situation.
Yeah.
But the Thai say we'll tax you on the entire duration of you owning the company. So it is a bit unclear who is right according to the treaty. I think what Thailand does is following the treaty, but because we tax you as a domestic tax resident before you have anything to do with Thailand, there's not much you can do. So just avoid getting into this situation. This is pure tax planning.
Yeah, makes sense. Thank you. And then dividends as well. So the same rule applies. So if you remit in dividends, then you are liable for the tax in Thailand according to your personal income tax rate, so the progressive tax rate. You can use any tax deductor, so any withholding as a tax credit. And that's how it works. So depending on the withholding tax taken, you can use that as a tax credit. But I think just has got some interesting things to explain that, you know, if you're in this situation, you know, there might be ways to reduce this or potentially make it a bit more efficient in the Netherlands.
Yeah, you should not be in this situation. You should not live in Thailand as an individual and receive dividends directly from a Dutch company that you own. That's just very inefficient and relatively easy to solve.
Okay, yeah, great. So common allowances and deductions. So once you've calculated exactly what you have remitted into Thailand, then we need to look at what allowances and deductions that you get. It's very small, but I'll explain it. It's in our tax guide. So everyone gets a personal allowance, 60,000 Thai baht. If you are married and your spouse does not have an income, that's not just income in Thailand, that's globally, then you get their 60,000 Thai baht allowance. If you have children, then you get 30,000 per child, and second child onwards, you get a slightly higher 60,000. Health insurance needs to be a Thai domestic local health insurance, 25,000 baht allowance maximum. And life insurance as well, that's up to 100,000 Thai baht. If you are 65 or older, then you get an extra 190,000 baht of allowance on top of your allowances. So once we add up all of your allowances and deductions, there are more, these are the common ones. You can look in our guide for all. Then we look at the assessable income, so what you've brought in. Then we go through the tax table. So the first 150,000 baht of everything that's remitted in after you take off your allowances and deductions is tax exempt. The next 150,000 is at 5%, and then it grows progressively. So if you are remitting in 5 million Thai baht of income over and above your allowances and deductions, the tax rate is 35%. So it's progressive. Let's explain that's all in our guide that you can download. So the clear tips for people to look at from the Thai side is you've got to really keep a good, clear record of what you have remitted, because investment capital gains to rental property income, to dividends, to salary, to retirement pension income are all taxed differently, and they're all looked at differently. So you've got to be able to tell which baht or euro was transferred to Thailand. And we use that using first in, first out method for the bank account that you're sending funds from. It's very important that you keep that list, and it's up to the individual taxpayer to be able to explain which source of funds this is from. We can help and support that to go through this. If you've got a pooled account, there is a method to do this, but it's important that you look at which is the source of income. You need to file a tax. Yes.
Remittance means put money on a Thai bank account and take cash in Thailand and pay things from a bank account, from a foreign bank account in Thailand, right?
Yes. Yeah. Yes. A good point. So remittance is any spending or benefit in Thailand. So let's say you use a Visa, MasterCard to pay for something in Thailand, and that comes off a Dutch bank. And in that Dutch bank account, you get a pension paid into there, or dividends, for example. That's remittance. Let's say you go to the ATM machine and you withdraw 30,000 baht in cash, and that's coming from a Dutch bank account. In that bank account, there is a civil service pension, only civil service pension. Then that is not, it's not assessable income. It's not taxable. It's we put it on the tax return, but it's not taxable, that money. So it depends on the source of the money to if it's taxable or not on there.
Right.
That's important to note.
Maybe wise to keep things separate.
It is, yeah. I mean, if people can, then different income sources in different accounts is perfect. It makes it a lot easier. But in reality, that might not be possible. But it's important to keep a good note on this and use that first in, first out method. If you need to file a tax return for the 2025 year, so this year, by the end of March. And if you do want to be kept up to date, feel free to sign up for the tax alerts, because I think things will change over the next year or two. It's likely in 2027 that Thailand will implement that every single person who is a tax resident will have to file a tax return. regardless if they've got income or not. So there will be further changes. And just for yourself, how can people get hold of you, and what situations are quite, where could you provide benefit for some of the expats that are here?
Yeah, I think anyone who lives in the Netherlands and has Thai sourced income, or the other way around, lives in Thailand, has any kind of Dutch sourced income, like your own company, real estate, a pension, will face some kind of double taxation challenge. That's something we can always help with and advise about. If you are thinking about moving one direction or the other, planning is very important because of the things we just discussed. There's some situations you just don't want to end up in. If you have a company which is active both in Thailand and in the Netherlands or anywhere else in Europe, you will probably need transfer pricing advice as well. So this means which part of your group's profit is taxed in the Netherlands, which part is taxed in Thailand. Both Thailand and the Netherlands are quite strict about applying those rules. So that is also something we advise about a lot. How to get in touch? You can see my email address there and my LinkedIn. I'm not sure if it's clickable. I hope so.
We'll
Otherwise,
make sure that we can. I've put the email in the chat, and also we'll make sure that we send that out. It's on the.
Perfect. If you just add me on LinkedIn, you can always reach out and send a message.
Yeah, great. Okay, thanks for that. So, as mentioned earlier, we do have an easy tax filing service. Everything's online. We've got a client portal, but if you do want to visit our office or speak on the phone, we can help. We have a lot of clients that sign up direct, fill out the details, and we can submit for them. We can also obtain tax ID numbers. So if you do need to file, you do need to get a Thai tax ID number. Two methods. One, visit your local revenue department office with the Thai forms and apply direct, or we can obtain within 10 days through our paid service. If you do have any quick questions, you can feel free to reach out to us, book in a time to speak to one of my colleagues to answer any questions that you have. If you do need a more detailed conversation, then we can have consultations to go through your situation in detail, especially with things like pooled bank accounts and fixing this first in, first out up until this point, and then putting together a strategy to make it a bit simpler, or just to go through the basics with your situation. So let's go into some of the questions that have come in by email. Then we'll go through the ones that have come through the chat. First question, there's a lot of rumors that rules will change. Why bother filing taxes when they may change the rules? Well, until we see any official documentation, so from the Revenue Department or by Royal Decree or in the Royal Gazette, then the same rules apply. There's a lot of times in Thailand and in the Netherlands where there's, talks or high-level discussions or even signed off by the government, but doesn't actually go through into law. So it's important that you follow the current rules and be kept up to date with any changes. Is there any input from there, Joost? I mean, it does look like in Netherlands things will change as well. Pretty uncertain.
Things will certainly change, especially in the box 3, so the tax on savings and investments. And every month or so, there's new suggestions from members of parliament. There is case law about this. So yes, a lot will change between now and 2028.
Yeah, I think also with government deficits, I don't think it's going to get any easier. So I think it's important to be kept up to date with current situation. We're thinking about moving to Thailand, but we're concerned about taxes will impact our retirement income. How can I assess what I have to do and if I have to pay more taxes than already paid? So with this, I do recommend that you book in a quick 15-minute consultation. One of my colleagues can go through with you the tax calculation to give you an estimate for how much tax you could potentially pay if you were a Thai tax resident and you bring in different income sources. So we can go through that in a quick call and really help for your situation, because depending on your age and circumstances, you do get a certain amount of allowances and deductions. It might not be as bad as you think. And how is tax filing being policed? So yeah, it's all down to self-declaration on your Thai tax return. For certain types of visa types, then the rule is that they ask for a tax return on visa renewal, and also with all of the common reporting standards and data that they are receiving now, they are actually doing active checks as well. And they're using the banks to do a lot of the work for this as well. And the same with the Netherlands, right? With the common reporting standards, it's not going away, is it? Just it's getting even more intense.
Yeah, exactly. And keep in mind that in the Netherlands, you have to file a tax return if you are invited to do so, or if you know or should know that you owe tax. So even if you're not invited to file a tax return, but you know that you probably should, you should. If you don't, they can get back to you years later, and interest and fines are quite severe.
Yeah. Well, with Thailand, the statutory list of filing time period is 5 years. So they can look back 5 years in Thailand in terms of your tax. But there is a but. If they think you have not filed correctly or fraudulently, then they can look back 10 years, 10 complete tax years. So this 5 years is actually, if they think you've not filed correctly, it's actually 10. So you've got to make sure that you keep the documents on file, on your own file, just in case you are asked. So one of the things that I think is really important is, let's say with your bank accounts, is to download all the statements every year, because you never know, right? You might not be able to get back 10 years. We've had a client recently that worked for an international company in Russia. His international bank closed his account. He can't get his records from his bank there. So anything can happen in terms of not being able to get those records. It's important that you download those, in my opinion.
And especially in the Netherlands with cryptocurrency, because banks close down, but crypto exchanges close down even more frequently. And it's really hard to explain to the tax office how it is that you suddenly have 10 Bitcoins if you cannot trace it back. So yes, always print PDFs.
Okay, yeah. Okay, well, let's put a few of the questions that have come in live on the screen. If I'm on an LTR, which is a long-term residency visa, does it mean we cannot file for taxes and get a tax residency certificate if spent more than 180 days? So there's a bit of misconception about this long-term residency visa. Long-term residency visa is just a visa type. It does not mean that there's nothing in the revenue code that states that you don't have to file a tax return. So even if you meet the criteria for a tax exemption on the income, it does not state tax-free. It has to be filed on a tax return. You can claim the tax exemption on there if you do meet the criteria, but also you've got to make sure that you do meet the revenue code's criteria. It's not just that if you have the LTR visa that there's tax-free or tax exempt. You have to follow the revenue code. Really important. Yeah, but there's no reason why you can't get you have to file a tax return, and that you can't get a tax residency certificate. To get a tax residency certificate, you have to file a tax return also.
Right. This is a common misconception indeed. Being allowed to live somewhere doesn't mean you do live somewhere from a tax perspective.
Yeah, let's have a look at some of the questions. Yeah, okay. This is quite interesting for just, that's a bit of, all right, let's just cut out this initial part so we can read it properly on the screen. Let me cut it into 2 parts. So could you elaborate on Bernal, Netherlands bridges to prevent NL tax residence? One case, the children from my wife can adopt, but not adopted by me, living in Netherlands, have a Netherlands bank account and investment accounts, having health insurance from a Dutch company, no real estate, etc. And of course, my parents and brother still live in the Netherlands. Furthermore, I work as a freelancer for a Dutch company. For the work, I travel several times per year to the Netherlands. Sometimes before and after business trips, I visit my parents. I am registered NRI, but any more at new display.
Yeah.
Yeah, it sounds complicated, to be quite frank. I don't think it's a difficult one to say yes or no, right? But
exactly, it's very much case by case. Of quite recently there was a advocaat-generaal who made the statement, which I think is a beautiful rule, that according to him, if you do not have a permanent place to stay, you clearly do not live in the Netherlands. This would be a good rule, I think, but it is not the rule. It's just his opinion. He does have influence. He doesn't make the rules. We know that the tax office looks at sometimes the craziest things to determine tax residence. But keep in mind that they usually go after the people they think they can get a lot of tax money from. So yeah, if you live partly in the Netherlands, partly in Thailand, and you have 10 offshore companies in Singapore and Hong Kong, they will probably try to make you a resident of the Netherlands. But if you live in Thailand for 11 months a year and you do some freelance business for a Dutch company and your brother lives in the Netherlands, that is most likely not enough for them to bother.
Yeah, okay, yeah, thanks for that. Okay, money remitted to buy a property, is it taxable as income in Thailand? So this is a very much it depends question. You need a lot more information. So if you are a non-Thai tax resident, so less than 180 days in a calendar year, you can remit as you please. You can remit assets from overseas. Also, if you are a Thai tax resident, so 180 days or more, and you remit money in to buy a property, it depends on the source of that money. Where's the money from? Is it from selling a property overseas? Is it from investment capital gains? Is it cash you've held for many, many years? Where's the source of this money? Is it inheritance? So it's important to really, one, are you a Thai tax resident in the year that you sell the asset or you realize an asset? Two, when you remit the funds, are you a Thai tax resident, and where is the source of that money from? So it's a very important, it's a very much it depends question. But yes, it doesn't really matter in Thailand what the purpose of what you're remitting money in for. If you send to a school for school fees, or you send to buy a property to a developer, or even to a landlord, or to a car showroom, or to your own bank account, to a wife's bank account, to a partner's bank account, it's still you remitting in the funds. So it doesn't matter where you send the funds. It depends on your tax residency status and what's the source of that money.
Yeah. So if you're planning to move to Thailand, it might be wise to buy a property the year before.
Well, at least have realized the gains in whatever you need to realize to buy the property. So you can bring it in when you are a Thai tax resident, but it's got to, you got to make the chargeable event's got to be done in a non-Thai tax year. If that makes sense. Yeah. So let's go a few more assets on, a few more questions on here. As a Dutch resident, does it make sense to liquidate and rebuy the profitable parts of my portfolio just to reset the capital gains at the end of the year before becoming a Thai tax resident? So that's tax planning for before you become a Thai tax resident. Yeah, I don't know about the Dutch side, right? That's not relevant for the question. What I'll try and explain is just for the Thai side. If you realize a gain and then buy back the assets in a non-Thai tax year, then your cost basis is the purchase price. So doesn't matter what, that's just might be able to explain the implications for selling an asset in the Netherlands. But the purpose for Thai tax purposes, if you realize the asset in a non-Thai tax year and you buy something back, then the cost basis is the purchase price. Yes.
Okay. Yeah. In the current box 3 system, you can do this because you're not taxed on your actual return on investment or the actual capital gain. You're only taxed on a percentage of the value on the 1st of January. So now you can do this. In the new system, which will probably be introduced in 2028, it's going to be much more complicated, and it depends on what kind of asset it is. And for that, I will refer to our website again, where I wrote 2 blogs about this.
Okay, yeah, thanks for that. Okay, rules for shares of your own company also apply to shares in a stock portfolio. So for Thai side, doesn't make any difference. However, whatever you hold, if you sell equity holdings and it's your own company, or you sell equities in its stock portfolio, if you remit those into Thailand, it's taxed on the capital gain. Yeah, so I don't know about in Netherlands. I don't understand the question so much. I think
in the Netherlands, it's very different. Yeah. Shares in your own company is box 2. Portfolio shares are box 3. Very different tax treatment.
Okay, another question about residency. We've got quite a lot about this. Just so, if a Dutch citizen doesn't have any permanent place to stay in Netherlands, hasn't lived there for 6 or 7 years, and has not lived in the country more than 180 days, can you do not have a tax resident anywhere? By default, you are a Dutch tax resident. That's a good question.
Yeah, this is the digital nomad question. And indeed, if you cannot demonstrate that you have a tax residency anywhere else, but you still hold a Dutch passport, then the Dutch passport in itself could be your tie to the Netherlands. So we always recommend, if you want to become a digital nomad, you better first move to a country that doesn't care. So you first establish yourself in a country who's not so strict about this, for instance, the United Arab Emirates. You live there for 2 years, you show everyone and the Dutch tax office that you really live there, and you do really live there. And once you go off from there, you'll be fine. But just become a digital nomad directly after being a Dutch tax resident and a Dutch citizen is risky.
Yeah. And also, like you mentioned, they can come back to you years later as well, right? So it's not.
Yeah, they will see this as a very long holiday, basically.
Okay, cash in the bank rules for Thai perspective. Does it literally have to be cash account, or can it be cash fiat positions, or equities broker, or crypto exchange? It depends on. Okay, so good question. It's about cash in the bank from when you were pre-tax resident. I assume that's the point. So if it's in a equity portfolio, it depends how the portfolio is held. If it's in your own name, it really depends how the brokerage account looks like and how it's held. That's really important. Also, it matters what kind of cash account it is as well. Is it a money market fund? Is it literally a cash account within there? Really important. And also for crypto exchange, it's not as straightforward as just yes or no. We've really got to look at what kind of portal you're holding or structure. It's not just the cash account within there. It's it matters whether it's a trading platform or not as well. So it depends. And also, if you've had money paid into there, it's a first in, first out basis for there as well. If you'd like to have a discussion, more detail, yes, an area where you've got to have a good look at what you're holding. It's not very easy for a yes or no simple answer. Basic situation, receive pension and AOW, both taxed in the Netherlands, live in Thailand. Part of my income is sent to Thailand bank. No double taxation will save me from Thai tax or not.
This is a nice one, because this is probably not correct.
Right. Yeah. So not correct in terms of shouldn't be taxed.
Yeah. Well, shouldn't be taxed here. So this is probably something you have to solve with the pension fund. They should stop withholding taxes.
You should stop taxing at source, right?
Yeah. And this is something we can help with. So reach out.
Yeah. Because technically, like we discussed earlier, it should be not taxed in the Netherlands if it's remitted to Thailand, taxed in Thailand.
Unless you were a civil servant, then
hey, yeah. Okay. Okay. Yeah, I think that's pretty much all of the questions that we've had in. If you do have any other questions, or if we haven't managed to get to some of the questions, feel free to get in touch. We're happy to help. So I hope that's been useful. Really appreciate your input. Just we'll make sure that your details are on the video and on the email that we send around.
Thanks. And thanks everyone for attending.
Thank you very much. Have a good evening. Bye-bye.
Cool.